those who have been cautious on the stock continue to remain so, while those who have been positive on the stock, they have maintained their positive stance. The next stock on a watch list is Wipro. Now, this is a stock which most analysts have been bearish on, and the second quarter numbers do not give much reason for analysts to change their view on the stock, at least for the time being. Now, the revenue growth for the second quarter was slightly better than what most analysts were expecting, but it is the margins which seems to be having analysts in a bit of a bit cautious on the stock, and there is no still clear signs about what when the margin recovery is going to play out. Now, also the company's guidance for the third quarter, that has also not impressed most analysts. Some see it as being very cautious, and in fact it seems to be, according to Nomura, the guidance by the company seems to be alluding to a possible slowdown ahead. Wipro is also the stock on which at this point most analysts have a sell rating. The overwhelming view is that probably the company and the stock is likely to disappoint. It had seen a good run up. The stock had hit an all time high sometime in Jan, but since then it has come off by close to about 40%. So, among all frontline stocks, Wipro is the one which has fallen the sharpest from its all time high, and outlook at this point in time is fairly cautious to negative, and among the analysts which have a rating on the stock, Morgan Stanley has retained its underweight rating on the stock and has flagged the fact that organic growth is lower than that of its peers like TCS and Infosys, and also the recovery in margins is pretty slow. Now, Wipro's margins are about 15%, and analysts are waiting to see when it will go back to around 17 odd percent, which was traditionally the operating margins of the companies in the past. However, the company still has not given any clear indications of that. Nomura has said that Wipro's guidance for Q3 has been quite disappointing. CLSA is the only brokerage at this point in time which has a slightly positive view on the stock. CLSA has an outperform rating on the stock, and it has a target price of 450. Now, CLSA's point of view is that valuations at current level are just about okay. So, which means that while the company's numbers may have been disappointing, much of it has already been captured in the stock price at current level. So, probably maybe the stock may not have much to lose from here on. The third stock on a watch list today is Hero Motocorp. Now, Hero Motocorp too has been one of the laggards in the auto industry among the two-wheeler stocks, which across the board have been seeing a bit of a rough time during the last few months. In fact, the performance of passenger cars and commercial vehicle stocks have been much better. Now, Hero has been struggling mainly because its strength is in the mass market, and mass market has been one of the areas which has been hit the hardest in the two-wheeler segment, and that mainly because of the cost of owning a two-wheeler has gone up considerably over the last year or so. Variety of factors there. One is also, besides the rising costs of vehicles, insurance costs, fuel costs, all these two have gone up, and now interest rates too are climbing. However, HSBC has a bullish view on Hero Motocorp, and according to HSBC, the company's entry into the electric vehicle segment, now this has been slightly delayed. However, it is still a positive signs. The company launched its offering Vida V1 a few days back, and according to HSBC, while this is slightly delayed, once the market matures, Hero Motocorp will still be in a good positions to benefit from it. Also, HSBC is of the view that the softness that one has been seeing in the mass market segment of two-wheelers, that has also led to a lot of pent up demand, and this pent up demand in turn at some point in time will work to Hero Motocorp's advantage. The most important part according to HSBC is that valuations at roughly 13 times FY24 earnings and 11 times FY25 earnings appears to be quite reasonable at this point. Besides that, the other part about market share, the overall market share Hero Motocorp has been able to maintain. However, where the premium segment is concerned, that is where the company has not been able to really make a mark for itself. However, HSBC is positive on that front also, and has pointed out the fact that its planned joint venture with Harley seems to be progressing well, and so HSBC feels that at some point in time you will also see the company make a big difference, improve its market share in the premium motorcycle segment, and all this put together along with reasonable valuations kind of make Hero Motocorp an attractive stock at current levels. The next stock on our watch list is Steel Authority of India. Now, in the steel space, Steel Authority has been one of the underperformers, and the latest development probably could further dampen sentiment for Steel Authority of India. Now, the government has scrapped its plan for the strategic sale of in this arm Visvesvaraya Iron and Steel due to insufficient interest from bidders. So, this could be a sentiment dampener at least in the short term. Now, the stock is down close to about 30% from its all time highs. It had fallen sharply to about 68 levels, since then 64 levels, since then it has rallied close to about 25%, and it is still trading below its book value, but at this point overall the outlook on the steel sector is not very positive, which is leading investors to back some of the better names, some of the top tier names in the steel sector. At this point in time they are Tata Steel and JSW Steel. Those are the stocks which are enjoying better ratings than SAIL. So, in some ways SAIL may be a bargain because of attractive valuations, but the market is not looking at it seriously enough. The company did manage to bring down its debt significantly in FY22, but in the first quarter again the debt levels have risen a fair bit due to higher working capital costs. Of course, the positive for all steel companies in general is that input prices are expected to soften a bit, but to offset that the demand has also weakened somewhat since last year. So, it's about the picture is evenly balanced for SAIL at this point in time. Last stock on our watch list this morning is Adani Ports. Now, the company has been awarded the contract to develop a deep sea port at Tajpur, West Bengal. So, this is one of the triggers that could improve sentiment for the stock in the short term, but stock has been fairly volatile of late and has fallen quite sharply over the last couple of weeks, in line with the overall bearishness seen in many of the Adani group stocks. Besides that, the company has recently got the NCLT's approval to buy out the remaining 58.1% stake in Gangavaram Port Limited, which is the second largest port operator in Andhra Pradesh. Well, with that the market has opened, and as expected, as indicated by the SGX Nifty, the trend is slightly bearish. Nifty at 17,088, down about 36 points. Nifty mid cap is flattish at this point in time. Overall market breadth is also good, close to about 1000 stocks, close to 1100 stocks are trading higher on the NSE, and close to about 600 stocks are down at this point in time. Now, we will have to see whether this trend sustains given the overall gloomy mood in global markets, and also the fact that India's macro indicators, key macro indicators of inflation and IP2 have shown some sluggishness. So, when you put all these together at this point, there is reason to be slightly cautious. The two key support levels, one at 17,000 and one at 16,800 on the Nifty, those will be the key to watch in trade today. Well, with that, it's a wrap on this edition of Markets with Santo and CJ. Thank you for watching, and please remember to share your feedback in the comment section below, and I'll be back with you at 3 p.m. this afternoon. In the meantime, stay logged on to moneycontrol.com.